everyone. I'm here with Devin O'Reilly, loan officer with Intercoastal Mortgage. And today I'm going to be asking Devin some questions, or actually we're going to be talking about some common myths, some common financing myths when it comes to buying a home. So, Devin, are you ready?
I'm ready.
Okay, so what's a common mistake or myth from buyers?
By far, the most common myth is the amount of down payment that's needed to purchase a property. So the biggest myth is that you need 20% down in order to purchase a home. And I would say as much as 75% of first-time home buyers do not have 20% down to make. There's a lot of times where they're given a gift, or there's the popular low down payment options. And so there's a wide variety of first-time home buyer programs that you can use. And you can put down as little as 3% and sometimes getting another qualified loan from a certain municipality. You can even get those funds gifted to you. So there's a ton of options you can use. And again, the majority of first-time home buyers don't have 20% down. So that would be the biggest myth, is that you need 20% down when the majority of people who purchase their first home do not have 20% down.
Okay, that's good information. So what about when it comes to shopping around for a mortgage? Because a lot of times buyers will hear from agents that you definitely want to shop around, but buyers are often fearful because they think that it's going to really hurt their credit score. So what would you say about that?
So that's an easy answer. So within certain industries, for instance, the mortgage industry, or if you're purchasing a car, you have to get your credit run. And so the bureaus actually do not punish you. The credit bureaus that make your credit score, they do not punish you for getting multiple quotes. So you have a 90-day time frame to get as many credit pulls from different companies as you want. So if you're currently working with a lender and you want to reach out, you heard someone else does a good job, you had a referral from a friend, you can have them take a look at your finances as well, and it's not going to hurt your credit score whatsoever.
Okay, that's good to know. So just as long as it's in that 90-day window, they should be fine.
Exactly. Okay. Exactly. And even if it's outside of that 90-day window, really pulling credit only hurts by maybe a point or two of that. And so a common phrase that's used is the ding. It might ding your credit by a point or two, but it's likely not going to be the difference between being in a 720 credit bracket and moving down all the way to a 700 credit bracket.
Okay. All right. So why should someone get pre-approved before looking at homes? A lot of times people contact me and they just want to see the home, they want to make an offer, and they want to jump right in. So from a loan officer standpoint, how would you respond to that?
Because you might fall in love with a home that you don't qualify for, right? You might find the one, but there may be some issues depending on your income, depending on where your credit is, that would make you not qualify for that home. Also, getting pre-qualified beforehand allows you to see what that sales price range is for you. The other reason is that you may love a place, you may qualify for it, but you may look at the monthly payment based on the loan workup and what your new mortgage payment's going to be. Maybe way too high for what you're comfortable paying. So if you love a house, but you don't want to pay $4,000 a month, you can see that by getting pre-qualified first.
Right. So definitely you recommend getting pre-approved before looking at homes.
100%.
Okay.
It's very quick and easy too. It takes about 15, 20 minutes.
Mm-hmm. And they can use an app or go online to access that application?
Yeah, and I'm sure we'll post at some point, just normally loan officers have a website and you have access to the application. The application takes about 10 to 15 minutes to fill out. It's just your personal information. So we can pull credit, and then you put your income and asset information in there, what's in your bank accounts, what your gross monthly income is. That's just your income before taxes. And then we take that profile and we see what you qualify for based on those parameters.
Okay. So this has been a crazy year, especially with COVID. So how has COVID been impacted by loans?
In terms of COVID, there have been a couple things along the boring side in terms of the guidelines that we have to get approved by a loan. There's an additional verification of employment that's required within 3 days of closing. That's normally 10 days of closing. We actually have to reach out to your employer and confirm that you're still employed. And that's a routine thing that's been a part of the mortgage industry for a while. And the credit bracket has kind of come together a little bit more. So if 620 was the basement score for a certain program, that might have moved to 640. But again, that's stuff that we look at based on your credit profile that may or may not impact you. And so once you do the application, we can see whether or not there are some impacts in terms of COVID. But things have really leveled out, I would say, over the past couple of months. And we're getting back to where we were in pre-COVID lending times.
Okay. And last question, how much should I put down? I found a house that I really like. How much should I put down?
That's entirely up to you. And so what my job is to work up the different scenarios showing you what mortgage insurance may be at 3% down as opposed to 5% down. So the less you put down, in general, the mortgage insurance tends to be more expensive. So you can either pay that mortgage insurance monthly, or you can pay it in a premium, or you can do what's called lender paid mortgage insurance. We raise your interest rate a bit to pay for that mortgage insurance. And so if you're undecided whether or not, if you want to keep some cash on hand, I'm sure we've all heard the term being house poor. You kind of put all your money into the down payment of your home. If you want to keep a little bit more, instead of doing a 10% down payment, do a 5% down payment, then we can show you what that would look like, how that mortgage insurance may change, and what your new monthly payment's going to be based on the lower down payment. So there's no right or wrong answer. People do all sorts of down payment options. And it's our job to show you what those different options look like.
Okay. Thanks so much, Devin. That's good information. I'm going to put a comment below with your information so people can reach out if they have any questions. So thank you.
Perfect, guys. Feel free to reach out.